It's been an absolutely torrid time for the pound over the last few weeks, with it crashing to historic lows when compared to the US dollar. This has caused concerns for economists and investors alike, with the US-UK currency differential affecting people's portfolios quite substantially. If you check your Trading 2 and 2 portfolio and tap more information on the growth of a US company, you'll be able to see it split down into the company's movement and the FX movement, and I guarantee the FX are propping up most people's accounts right now. The volatility in the British pound is causing some economists to suggest it's trading like an emerging market rather than a main currency within the world stage. The question really is, why is the pound falling, and what does it mean for your investments, your household and the British economy? On Friday the 23rd of September, massive tax cuts were announced within the United Kingdom by the new Prime Minister and the Chancellor, and this sent the pound into a spiral. This was just the start though, with the pound pulling back to $1.0327 last Monday, its lowest point in 40 years, before regaining slightly to $1.05 per pound. This has all been triggered by worries around the government's tax cuts and the fact that it will increase government borrowing at a time where inflation is already rampant and completely out of control. Increased borrowing at a time like this will mean that the country's debt will continue to increase as it's becoming even more expensive to service that debt due to rising inflation rates. A bit of a vicious circle really. This mini budget will put the UK government's borrowing at over 92% within the next 5 years when compared to the country's GDP. And this puts us in a very precarious position with regards to the country's economy and the ongoing prosperity of the UK. Analysts have called for the Bank of England to intervene and raise interest rates to stop further decline and potentially prevent the pound hitting parity with the dollar. Even 15 years ago, this is something that wasn't even considered. At that point, it was $2 to the pound, but the pound being an incredibly strong, internationally recognised currency. It suggested that an emergency rate rise by the Bank of England could help to prop up sterling and stop the markets from spiralling out of control. This, of course, won't be any comfort to the normal household out there, because rising interest rates just means that people are having to fork out more every month for things like mortgages and consumer debt. Personally, I don't think there's been enough discussion over mortgage rates as there should have been. We could find ourselves in a seriously troublesome situation if rates continue to increase and there's a continued lack of support to normal people. If that's not enough to worry about, there is discussion that a falling pound could increase the rate of inflation. As the pound gets closer to parity with the dollar, this is only going to increase the cost of goods and services, potentially worsening the cost of living crisis that we're all currently experiencing. There are suggestions that the recent fall in pound will mean that even into 2024, we're seeing an extra 0.5% inflation than what we were expecting already. When we consider that inflation is already at 9.9% within the United Kingdom and potentially predicted to get worse over the next 6 months, that is not something that anybody wants to hear. The falling pound is also going to impact things like food prices. Products imported into the UK, like foods and drinks, will become relatively more expensive. Whilst they'll still cost the same to import from the external country, we'll have to pay more for the privilege of using those products because our pound is weaker when compared to the currency from which we're importing. Grocery inflation was over 12% in August, and that's only expected to get worse as the energy crisis starts to hit supermarkets. Going on holiday will become more expensive, especially when going to the US and other countries where the pound has fallen relative to the home currency. If you were going to America 15 years ago, you'd be able to get $500 for around £250. Whereas back last week, it would cost you £480 to get the same $500. Shocking really. A falling pound will also hit the airline business within the United Kingdom. This is because of increasing fuel costs and the increased cost of leasing aircraft. Carriers pay for a large proportion of costs in US dollars, largely fuels, which will push up flight ticket prices, even for some of the cheaper airlines out there. The silver lining here is that holidays to Europe are likely not to increase too much because the euro has dropped to a 20-year low. So if you're still looking for cheap holidays, Europe is definitely the destination of choice. While higher interest rates mean that people are more likely to save, bringing more money into Great British pounds and thereby propping up the value of the currency, the cost of borrowing for both households and businesses will rise substantially. While the pound is likely to be propped up somewhat by people moving their savings into into the United Kingdom, the rate of inflation is likely to reduce any profits that you would make from holding money in your savings account anyway. With UK-based inflation currently at 9.9% and the best savings account for regular saving that I can get my hands on at the moment with an interest rate of 5%, I'm essentially losing 4.9% every single year for any cash that I hold in that savings account, despite a very good interest rate on the savings. For investors in the UK out there, a weaker pound does tend to be good news for the FTSE 100 and the companies that are held within it. This is because most companies listed on the FTSE 100 earn a lot of their revenue overseas. This means that the profits will be worth more when they're converted back into pounds because of the relatively weaker pound when compared to the currency that the profits were earned in. On the flip side, the FTSE 250, which is largely exposed to UK-based companies earning most of their money within the United Kingdom, are likely to be impacted more substantially by a weakening pound. And with regards to bonds, let's not even talk about that. The announcement last week sent the bond market in the United Kingdom into a complete meltdown. If the Bank of England hadn't started to intervene and buy up these bonds, many pensions out there would have completely collapsed because of margin calls. So all in all, it's a pretty gloomy outlook for the pound at the moment, and it does question what's the best use of your money right now. There are of course some excellent deals out there on the stock market at the moment that you can take advantage of. But if you're investing in the US stock market, you now have to spend more of your pounds to get the same amount of a company. While of course it is important for your long-term financial freedom to continue to invest, it does put a question over where's the best place to put your money. For myself, I'm continuing to invest in the same 6 ETFs that I've held for the last year and a half, and I'm not going to be changing anything for the amount that I'm putting into these. For some people, like myself, that is the right decision, but for other people with large amounts of consumer debt, it may be better to put that money towards paying down the debt. With the stock market falling, the pound crashing and spiralling inflation, it is a fairly uncertain time for any money that you lock away in an investment. A preferable way could be to guarantee return by paying down debt with large interest rates. If you've got consumer debt at the moment, really of anything over 7.5%, and you start to pay that down, you're getting an instant return of 7.5% on your money because you're not going to have to pay the interest on that capital because you're paying it off earlier. As I've said for the last few months, I only see this getting worse over winter and into early next year. Government support, despite that little bit of money towards energy bills, isn't going to come really until April of next year when the tax changes come into effect. There are a lot of people out there who are significantly worried about how they're going to make ends meet, pay for bills and whatever over the next few months, especially with rising energy bills and Christmas coming. For the United Kingdom, it does feel like a massive fall from grace, being one of the economic superpowers to where we're sat right at the moment. I'm sure in time things will turn around and we will rebound strongly. However, growth within the UK over the next 10 years is going to be questionable. And that is of course impacting everybody's investment portfolios. Check out my Vanguard account to see just how much it's decimated my portfolio over the last month. And if you are in a situation where you're needing to make more income every month, check out my match betting video, which hopefully will help you make between £400 and £600, which I really hope will help people make ends meet if they're struggling at the moment. Stay safe out there.